So you brought your CPA in today.
I've known Scott for a very long time. We joke that the first dollar that I ever made, which probably when I was 15 years old or whatever it was, the first legitimate dollar that I made, Scott was there to help me. So I've known Scott for quite some time. The best CPA I've come across.
And I assume that we're here today to talk about Steve's rounding issues. It's an intervention.
No, we're here to talk about legal things.
Steve, this is an intervention for your rounding issues. No, we're going to talk about flipping houses because the market's been good. It's good for a long time. I'm seeing it every day. In fact, just this morning, I saw one of my friends on Facebook who said, hey, bought my next flip today. He said, I think, quote, this one has a little hair on it, but I'll make it pretty. I don't know what that means, if it means he bought it too high or higher than he wanted to, or if it has more work that needs to be done than he thought. I'm not sure, but I've always discouraged people from flipping houses. Maybe I've talked people out of making a whole bunch of money, who knows, but there seem to be more risks involved, in my opinion, than what the rewards are worth, and it's sort of like one of those things where like if you just bet on black all the time on the roulette wheel, eventually you will lose. Do you know what I mean? Mm-hmm. And that's what a lot of flippers do, is they just keep parlaying profits into new properties and expansion. It's like at some point you're going to lose. So that was my rationale. But there's more to it, right? From a tax perspective. Explain some of that to us.
Well, flipping versus using rental as an investment, if you're flipping houses, meaning that you're doing this a lot, meaning that you're buying properties, renovating them and selling them, if you do it enough to where the IRS sees that you're doing it in volume, they can say, hey, you're not really investing as in the sense of being an investor. So this is what you're doing for a living, even if you have another job. And then what happens is you lose all of the benefits that you have as an investor, such as paying a lower capital gains rate. They classify this as something that you do as what's called a dealer. And when you're a dealer, that means this is what you do as a living. So you start paying ordinary income tax rates, and you start paying Social Security tax as though you were working at this as a self-employed individual.
You're like a property dealer.
Yeah, you're a property dealer. So now instead of paying maybe 15% capital gains tax to the IRS, you're paying maybe 39% tax if you're lucky enough to be in that bracket. And then not only are you paying no Social Security tax or Medicare tax, you're paying 15.3% Social Security tax on that. So you run the risk of doing that if you're doing this in volume.
Gotcha.
This has nothing to do with whether you actually make money on the deal. If you make money, if you don't make any money, it's a moot point. But you're talking about the risks about whether it's even worth it. But if let's just say you're lucky enough to be profitable, now you're paying a lot of income tax on top of it, because it's no longer you bought something, it grew in value, then you sold it, and you just paid capital gains taxes on it.
Do people not know this? Like, are they fudging it? Is there a way that like the typical flipper or investor is like not understanding this or filing improper tax? I mean, in other words, is it possible there's flippers out there who think they're making a killing, and if they went back and actually had their taxes audited, they'd be in really bad trouble?
Oh, it's possible. I find I've been doing this for quite some time, and I find really most people are honest. They're really not. They really don't set out to break the rules. That's been my experience, I'm happy to say.
Even with Steve?
Even with Steve. Most people, in my experience, are honest people, and they don't want to do things wrong. They want to do things right. And many of the mistakes that I see are just because people didn't know any better. They didn't know, it's simple. You buy a house, you fix it up, you sell a house. You've always known that this was a capital gains kind of a transaction. Then you find out, oh, gee, if I do this, and the IRS thinks that I'm doing this as for a living, or if I do this a certain amount of times, and there's nothing in the code that says if you do this 3 times or if you do this 4 times. It's a fact, what they call facts and circumstances. If you do this enough to where they perceive it this way, it could be as few as 3 times. It's just one of those things where they say, you're really not doing this as an investor. You're really doing this
as a job.
You're doing this as a job. This is not investing. This is really how you're making money.
So is it a percentage of your income, or is it how do they determine it? Because as a real estate agent, I come across a transaction, let's say, and I invest in it and flip it. You're saying that there would not be the tax implications as inventory. Of course, it would be capital gains because it's not a primary residence. But I could do that up to some ambiguous number, and then it would become part of.
Well, there's a rule of thumb of 5, and,
Okay.
and that's even written in some of the regulations and so forth. But it doesn't have to be that way. You know, that's the problem. When you're asking me, it'd be a lot easier. And I thought we were going to be talking about things like depreciation recapture and things that we can, as CPAs we can talk about because it's in the Internal Revenue Code, and it says you depreciate this property over 27 and a half years and so forth. But when you're talking about the dealer status, there you have to look to the court cases, and you have to look at how they've ruled in the past, and what it differs by jurisdiction. It really is facts and circumstances, and a lot of times in those circumstances, common sense prevails. I mean, if you've only done this a couple of times, I wouldn't lay awake at night worrying about it.
Yeah, you're making your money selling real estate, so I don't think
And also, a lot of it also has to do if you're subdivided. This comes up more for me, not for somebody who's buying properties and selling, because it takes a long time. Usually when you buy a property, it's not one of those instant turnover things. Usually, if you're going to get a good deal, it's because the property has hair on it. Meaning, usually it means it needs a lot of rehab work.
What's wrong with hair? Anyway, what happened?
Hair
used to be okay, not okay anymore.
It takes time. So if there's a lot of time that transpires between these deals, it's not the issue. Where I've seen this come up as an issue more is where somebody owns a large piece of land, and all of a sudden they've subdivided it and they're putting 7 units on it. There you have a deal issue.
Now you're in
because now they're selling 7 pieces of real estate.
That's such a shame. What a bummer.
Yeah.
We are ready to shoot the messenger now, Scott. You didn't expect these zingers today.
Well, yeah, I thought we were going to talk about selling rental properties and maybe doing 1031 exchanges to avoid the real estate tax or the capital gains tax.
That's just what we wanted you to think.
That's just what you wanted me to think. Okay.
Just had to get you here.
Okay.
Now that we got you. Let's talk about, because there are, you hear people sort of round it off, and the rounded off comments are fine because for most people they just need to understand if something's a positive or a negative. But if you are buying a home and owning real estate, and there's several different ways: primary residence, investment properties, properties to flip. Those are different ways that you can own real estate. There's different tax consequences and different tax advantages for those different realms. So can we dive into some of those? Like primary residence, there's some obvious ones.
Sure, primary residence is great. The best thing about primary residence, of course, is Internal Revenue Code Section 121. That's if you're single and you sell your primary residence, it's been your primary residence for 2 of the last 5 years, you get a $250,000 capital gain forgiveness. That means if you make up to $250,000 of profit on it, you pay no income tax, either to the IRS or the state of California. If you're a married couple and you both own the property, it's $500,000. So in simple English, you pay $800,000 for a house, and you're married, you live in it for 2 years or more, and it's your primary residence. I won't get into all the things that make, but think of it, it's the place that you live for 2 years or more, and you sell it for $1 million, you make a $200,000 profit, or you sell it for $1.2 million, you make a $400,000 profit on it, you get to keep that money. You don't have to pay any income tax on it.
And is it net the fees? Of course, in that situation, there's commissions, there's closing costs.
Net the fees. So let's say you make a
net profit.
Let's say you make a gross profit of $550,000, and after the fees, it's $475,000. It's tax free.
Tax free.
Let's say afterwards it's $525,000. You pay tax on $25,000. The other $500,000 is free.
Got it.
Great deal.
It's an unbelievable deal, and this is where Steve and I like to argue because, Steve thinks you should hold real estate forever. You should never sell it, which I understand why, because it will go up over time, and if you can keep it forever, that's great. But you don't get to take advantage of that specific provision right there if you don't cash in.
It's got to be your home, though.
It has to be your primary residence. Correct, and that's the trickiness of it. Is because if you love your home, you should never sell it. Right?
And then there's also a caveat, which is, let's say I live in a home and move out of it. You said, of course, 2 of the last 5 years, it's considered my primary residence. But then if, let's say I bought a new house and I sell the old house that I lived in 2 years ago, isn't there some kind of provision that prevents me from immediately then selling the house that I'm in? I can only
you can only do it once every 2 years as well.
Okay.
So yeah, it'd have to diagram it on a whiteboard to show you, but more or less, it's people still get confused this rule came about in 1997, and so people still remember the old rule where you had, when you sold the house, you had 2 years to buy another house of equal or greater value.
To reinvest.
You had to reinvest the money. And I still, 20 years have gone by, and I still get questions saying, well, what if I buy another house and I put, and it's not that hard anymore, and then if you're over 55, one time and one time only, and for only one spouse, you got a $125,000 forgiveness. That rule went away, 20 years ago now. It's been that long, but people still remember that rule. That code section doesn't even exist. I think it was 1034. If I'm not mistaken.
They may be getting it confused with 1031, which
1031.
is another huge benefit.
Wonderful code section.
Been on the chopping block for many years.
Every year.
The lobby comes back and they ask me to go speak at a hotel somewhere and talk about 1031 exchanges. But it is an amazing gift for people who are investors. Now, does this apply to all investors, even, let's say, dealer investors?
No, not dealer investors.
So it's only individual
investors. Only individual investors, and it's not, believe it or not, it didn't even start out as a real estate code. It's like one of those things where it's an unintended consequence. It really started out back in the 20s and 30s for, like, say, a farmer who had a tractor and wanted to get a bigger tractor. That's really, and it still exists for that, by the way. It's just nobody ever thinks of it for that.
You can use it for other assets.
Yeah, it's supposed to be a business asset for a business asset, and that's why it has nothing to do with dealers, because that's inventory. That's not a business asset.
Gotcha.
There's a big, I don't want to bore people with the distinction, but there's a big distinction between inventory, like going to a Home Depot and seeing, a wrench on the shelf that you're going to buy. That's inventory. Versus a business asset, which is something that you use to produce income for your business.
Like the cash register.
Like the cash register, exactly. Or like a rental property, which is your business asset that you're using to collect rent, your source of revenue. Gotcha. That's the concept. So the idea is you have this business asset, a rental property, and you say, I don't want this rental property anymore, but I would like another one. So what I want to do is I want to sell this one. And rather than take the profit and pay the tax, and I'm going to take my gain, and I'm going to take all that money and reinvest it into and the rule is to defer, not avoid, not eliminate, but to defer my taxes. I'm going to take all of the money that I made, all of the sales proceeds, I'm going to roll it into the next piece of property, or pieces, because you can buy multiple pieces of property. I'm going to defer it into the next piece of property or pieces, and defer the tax and reduce what they call the cost basis of the new property, and keep on going. And so in the simplest form, I have a house that was $500,000 after depreciation. It's now got a cost basis of $400,000. I sell it for $700,000, so my gain is $300,000. I then take that, and there are rules for a 1031 exchange. I can't have use of the funds. Funds sit with what's called an accommodator, and there's a time frame. And
6 months, right?
You have to identify the replacement property in 45 days. You have to close the deal within 180 days, and there has to be equal or greater debt on the property, and a variety of other things. But then you buy a property of equal or greater value, and so let's say you buy a property for $1 million. And so what happens is that $300,000 of gain gets rolled into the $1 million property. So you start with a basis of $700,000. I'm simplifying it, but that's essentially how it works. And then you start depreciating.
I thought you were going to reach out and choke me.
He's
lining up for it here.
Yes, that's the New York part, the hand gesture. But anyway, that's essentially how it works. So what the benefit is that normally in that scenario that I explained before, if you just sold it for $700,000, you'd have tax on $300,000 that you were looking at paying.
Correct.
That's quite a chunk, and a lot of people aren't very happy about that.
And in an investment situation, you don't get any of that tax freeness.
If you bought stock for $500,000 and you sold it, for $700,000, you'd be paying tax.
And the same thing with investment real estate.
Right, and I mean, there are worse things that can happen, but I've never yet given a tax return to a client where they owe tax on $300,000 where they said, "Oh, this is great.
Yeah.
I'm so happy you've done this for me, and thank you very much."
Would you rather not owe any tax? Is the question.
I mean, most people do understand that they made the money and so forth, but by then they've already spent the money, and this is now
paying taxes is a good thing, man.
Yeah.
If you don't owe any tax, then either you're super rich, you might have a client or two like that, Scott, or you didn't make very much.
Well, I'll keep
Those are the only two
I'll
options.
keep you in the lobby of my office so you can speak. You can speak to my clients on their way out the door, because I don't.
I'll stand there and interview people.
I don't seem to do a very good job at that. Nobody leaves happy. So.
Well, some people get refunds, don't they?
Yeah.
Most people should be happy.
Yeah. Well, they get refunds. That means they paid too much.
That's true. That's true. But I mean, gosh, I remember the days getting refunds. That was like the best thing ever. Talk about free money.
Yeah, it's your own money, though.
It's your own money.
It is, but it doesn't feel like it. It feels like it's someone else's. When the check comes from the government, it feels good.
It's all psychology. It's all psychology.
True. So that's primary residence. There's that exclusion for the capital gains tax to a certain degree, whether you're single or married. For investment real estate, you have the 1031 exchange, which is huge. But depreciation is one of those things that I don't know. I'm not a huge fan, and the only reason is because I don't understand. Eventually, you have to take it. So, like, what's the advantage of depreciating the asset now to gain a little bit of tax love each month or each year, to then have to pay it all back at once in a calendar year in the future? Like, how is that a benefit?
Well, at the risk of sounding somewhat smug,
please sound smug. Be smug as hell.
It doesn't really matter whether it is or it isn't, because in the Internal Revenue Code, it clearly states depreciation is taken. It's allowed or allowable by recapture. You're referring to at the end when you sell it, and the fact that you have to reclaim it as part of your gain.
Yes.
So the IRS requires you to calculate the depreciation when you sell it and claim it whether you took it or not. So it's only to your detriment if you don't take it.
What?
Yes.
You have to recapture depreciation that you didn't take?
Because it's the law. Okay, now
so you have to take the depreciation.
You have to, and the reason you have, I mean, I don't want to justify the IRS, but the reason you have to do it has
justifying the IRS, Scott.
Well, it has to deal with the concept of economic reality. The economic reality is this: if you buy this cup right here,
which I did,
and you write it off because you spent the money for it.
Sure.
Okay, so the same thing. You buy a house, and they don't allow you to write $500,000. You never write off the land. So let's just say, to make it easy, you buy a $500,000 house, and you say that $400,000 of it is the structure and $100,000 is the land.
Okay.
So the IRS isn't going to allow you to write $400,000 off, and the reason is not because they're mean, or it's because it doesn't devalue $400,000 in a year. Now the number, I don't know where they come with 27 and a half years, but that's the number. So it's 27 and a half year life on a $400,000 residential structure. If it was a commercial structure, it's 39 years, and you start writing it off. And the point is that you would be writing it off if it was any other asset. You don't get to pick and choose whether you write it off.
But I get to write off 100% of my cup purchase, though.
Right. Well, because in theory, this thing devalues within a year.
What do you say
this
about
place is a sham. Their cups are worthless.
Worthless cups.
But so the thing is that at the end of the day, whether you chose to or not, you should have written it off.
Sounds like a disadvantage still, though, because I mean, what if let's say I bought $400,000 worth of cups that I'm gonna resell or whatever, I get to write off the whole $400,000.
Not if you're gonna resell them, then they're inventory.
Okay. So let's say it's something else.
Touche! Take that, Derek Evans.
Yeah.
Trust me. Finer minds than mine have thought this through.
But
we can argue it, but the point is, it's the law.
No, but I mean, like I'm just saying the disadvantage to investing in real estate is what I'm saying, because you're saying I don't get to take the whole chunk right at once. Let's say this cup was $400,000, I would get to take the whole thing all at once, right? Whereas if I buy real estate, I have to take it over 27.
That's hardly a disadvantage, though. I mean, every year you're getting rental income, so every year you're offsetting that rental income with the depreciation expense. remember that every year when you're
So that's the advantage.
that's a huge advantage.
To which, and as a caveat, of course, so I understand it more, is that you can only depreciate it when you receive income. You had mentioned you don't depreciate vacant land. You don't depreciate.
Well, you never depreciate land because land's not a depreciable asset. Period. And it's part of your basis when you sell it. So remember that when you're figuring out your capital gain, you then get to that. You then reduces your gain because you then get to claim that as part of your cost basis. So remember in that $500,000 house. So let's just think this through all the way. That $500,000 house. They're not punishing you. They're just making you pay back the write-off that you've taken over the years. And they're not making you pay it back. They're just saying, okay, look, you've written off this house. You've taken $400,000. Let's say you've had it rented for a number of years, and that whatever that number of years has been, that write-off is equal to $50,000 of depreciation. So now all they're saying is, it's no longer a you have $100,000 on the land, right, and you have a $400,000 original basis that's reduced by. I'll keep these hands away. It's reduced by $50,000. So now they're saying now you really didn't pay $400 for it anymore. You really paid $350 because you've written off $50,000 of it.
I see.
So all they're saying is it's not that you're paying them back. They're saying it's no longer a $400,000 basis. It's really a $350,000 basis because you got a tax benefit already for the $50,000. We're not going to give you a double tax benefit for it. You already got a $50,000 tax benefit over the years that you were taking it against the rental income. And by the way, you do get, if you have it actively placed as a rental, if you're advertising it, you just were unlucky, it was a slow market or whatever, you still get to write off the depreciation. You still get to take it as an expense whether you got rental income or not. It still gets put on your Schedule E as a rental expense.
As a negative.
As a negative. So, it just gets deducted from your other income.
Okay.
There are rules about passive losses, and if your income's over $150,000, it all comes out in the wash. Real estate is a phenomenal investment over the long term, as long as you buy and sell properly. That part, the tax.
So as long as you listen to Steve
and
not Derek.
I mean, obviously, I'm talking from a tax perspective over the long run.
Yeah.
People make the mistake of buying it. I get calls all the time. Oh, I've been told I'm paying too much taxes. I need to buy real estate. Well, no, that's not the reason you buy real estate.
Right.
If you buy properly, if you get a good deal, and you use it properly and do things correctly over the long term, it can be a very good investment, and it can work out very well tax-wise in the right circumstance and if you plan it properly.
Well said, Scott. Well said.
Boy, that shut me and Derek up.
Yeah, we were just zip it. Shut you both up. As long as you buy or sell it properly. I've heard the same thing. People say that, oh, I'm paying so much in taxes. I'm W-2, 200 grand. I need to buy a house, which may or may not make sense. And similarly, for some people, if they're not itemizing deductions, because we didn't talk about the interest write-off, which is typically the number one thing. I was actually surprised you mentioned that earlier, that wasn't the first thing you talked about.
Yeah.
Because a lot of people look at that and they say, that's what I need. I need something there because then I can add that over here, take that off of my income, give me a lower bracket or whatever. But some people who don't itemize their deductions, there's no benefit to that at all, right?
Yeah, I overlooked the obvious. That's true. The federal government, of course, gives you what's called a standard deduction just for being you. But if you buy real estate, and eventually, especially here in California, it's not necessarily true all over the United States, but we're in a California mindset. It's virtually impossible to have a mortgage where you're not paying more mortgage interest, even at low rates, than the standard deduction is. So you're usually paying more than $6,000 of interest, or $12,000 if you're married, of interest in mortgage interest. So and then of course your property taxes become deductible as well. So generally speaking, if you own real property, you get into that itemized category, and then you start getting to write off the things you didn't write off before, like your charitable contributions, your DMV fees, things that normally don't matter if you're just paying the standard deduction, because those things don't count. It all falls in your standard deduction. So that is a primary benefit of homeownership. That may get taken away if if there ever is a new tax reform, we're not a political show here, so. But that's
Aren't
one of
we?
the things. That's one
Now
of
the real reason
that's-
you're here has surfaced.
That's what. But that is.
I'm glad you mentioned
yeah,
that.
No, seriously, that is one of the things on the table. One of the things on the table is to simplify the tax code. They're talking about making the standard deduction much higher, and taking away the and in exchange for that, taking away the itemized deduction for property taxes and mortgage interest.
That would just rip the heart out of the real estate industry.
And I think probably that the smart money is that they're not going to do that for that very reason.
I'll tell you right now, there's no way.
Yeah.
I'll just tell you right now, the National Association of Realtors is so deep in Washington. There is no way, because that would be a major blow to the real estate industry.
Yeah, and they also said that there was no way that the Cubs would win the World Series, and there was no way that Donald Trump would be president. I'm just saying. So I've learned not to say there's no way for anything after 2016.
Well,
that's all I can tell you.
That's true, but I mean, the NAR, you have to realize though, NAR is huge, and they've gotten their way with everything. Now, the mortgage lobby, not
small,
so
tiny.
Not so. They've been smacked around all over the place. But even though it's mortgage interest, it's a real estate benefit. It's a real estate sales benefit tool to be able to look at that. Because for a lot of people, especially here in California, they do itemize. Therefore, it does apply. And since their payments are $3,000-$4,000, you know, first-time buyers maybe pay $2,500, let's say, for a first-time home here in San Diego. A lot of that is interest. So that adds up. It's like, wow, hey, you could take almost $30,000 this year. Take it right
that
off your
said,
income.
though, your recent gambling hasn't worked out so well.
I have to write that off against my winnings.
There's
Still
quite a lobby for the flat tax too, which makes everything I say completely moot. So you know.
Yeah, that's true. Would you be around if there were flat tax?
No, I'd be sweeping the floor of your of your studio.
If I just put the ad in Craigslist.
So no, I mean, but that's always. I mean, and you know, maybe that's the answer for the economy. Maybe maybe that's not. But I'm a pig that feeds from that trough, so I'm not the right person to ask that question to. So you know but you know, under current law right now, that is a huge advantage to owning a home. That's always been a huge advantage, and of course they have that. You know, people. There's always the socio-economic question of should you use tax code to promote social issues, and the reason that's in the tax code is it was to promote homeownership. That's the whole reason it got put in.
Definitely.
So I mean, there's a philosophical question of, hey, should the tax code promote social policies like homeownership?
Mm-hmm.
Not for me to say. It's just that's how it originally got into the.
You can say it's social, but I think it's very economical.
Oh, yeah,
I mean, you know,
but that's how it originated into the code, and so and it has been, you know, it has made homeownership more affordable. Also, one could argue it's made it a lot less affordable because the investment opportunities is also what drove, one of the things that drove California prices up so much back in the 80s, or in the 90s, I beg your pardon, was in 1997 when that Code Section 121 came in, and with that $250,000 or $500,000 rule, that's when I saw things really explode. People were moving into their rental properties. And,
things have to become affordable before they can become unaffordable.
Yes.
Right? If something's unaffordable to begin with, then it just doesn't exist. It's just like cell phones. Watch what happens. Like, it seems like right now prices are going down, and then watch what'll happen over time. It'll start to go up and up and up and up. Once everyone is assimilated and it's become clear that everyone has to have a cell phone, then prices will then go higher, and that's just kind of how this stuff works. And the same thing with homeownership. Everybody should and wants to own a home. The cornerstone of any good, solid financial plan is you own a home, because one day you don't have a payment and you can actually retire. But everyone wants that. People get that, I think, which is why we have an issue. Because especially here, you know, we don't have enough space for all the people who want to live here. Other areas of the country, not the case. No problem. You know, you can go and you can buy a house in my hometown for $150,000. They're all day. I mean, you have a lot to choose from if you have a $150,000 budget, and you'll get to buy a house, but you won't get as big of a deduction. It won't make a big difference. There are a lot of people back there who that just doesn't apply to.
Exactly.
So it changes things. So like you say, oh, well, if we put the stimulus in here, it makes things go like a flame. In places where it doesn't really apply, not so much. So which is better? It's tough. It's a supply-demand thing. I think you let the market take hold.
Not that very true.
I'm glad you agree with me. I win. That is the end of
I wasn't
the
arguing
segment,
for taking away the deduction.
Thank you guys so much for coming in today. It's been really informative. I appreciate it.
Pleasure.
Scott. Tremendous stuff. And Steve Ploetz, of course, who didn't round a single number today in his favor or at all, which is an amazing accomplishment.
Next time I'll double it.
Okay. Thank you for joining us. Appreciate your time. We'll see you soon.